Hello, everybody. It is Helmer here with your weekly mortgage market update. It is May 17th, 2023. This week, I am joined with a gentleman that I would even call a friend. He's watched me shoot. He's thrown skeet for me. How are we not friends if you've thrown skeet for me? Mr. Randy Teakell. How are you, Randy?
I'm just blessed to be here.
So awesome. Do me a favor. Tell everybody just a quick snippet about yourself.
Yep. I'm a mortgage guy, been a mortgage guy since June of 1989, and a broker. Last 5 years been a broker and part of for the last 5 years, part of Vetted VA. So I just enjoy helping people. I love veterans and helping anybody, but veterans are my passion.
Absolutely. Awesome. Well, thank you for joining us again, everybody. This is your mortgage market update. And what we do here each week is basically just try to give you some information on which way rates are headed, what's going on in the mortgage market so that you guys are informed. And whether you're out house hunting or you currently own a home and you may be thinking of refinancing or any of that, we're here to answer those questions for you. If you're here live, do us a favor. Go ahead and let us know and ask any questions that you have. Be a part of that conversation. If you're watching replay, do us a favor, give us a hashtag replay. We do monitor this post. Go ahead and ask your questions or share any thoughts that you do have, and we'll be glad to answer those for you. If you're here live, make sure you go ahead and say hello. So I'll put my little ticker up. Let's go ahead and jump right into it then, and let's talk rates. Remember, this is not an offer to lend, and when we talk about rates, we're talking about averages and generalities. You guys can ask any specific questions you have about your scenario, though, if you are here live and you want to ask, or if you're on the replay, post them in that thread. We'll be glad to answer them. You can, of course, tag myself, Helmer, or tag Randy, and we will make sure that we get you the right answer on that. So quick heads up on what we talked about last week. Last week on the markets, I said that rates were likely to continue in this range. And I use that word range because rates move up and down, usually at least daily, sometimes even during the day. And the range that we've found is about 0.25%. Right now, rates have been in kind of an equilibrium. We've seen rates over the last, I want to say, Randy, what do you think? I'm thinking maybe 2 months where they've been in this kind of quarter point, give or take, but they haven't really moved much.
Yeah, other than a couple of days that, like the 1st of May and whatever, when we had some stuff that had some good positive knee-jerk reaction, it's been pretty much in that same channel.
Yeah, things have been pretty consistent. So we've seen a lot of the, that same kind of range. Things are, like I said, rates have found an equilibrium during the pandemic. Of course, we had phenomenal historic rates, 2s, 3%. Now we're back up in those 6s. In fact, let's take a look here and see a quick recap of kind of what happened in the last week. Rates remained in that range. Some days were slightly better than others, but overall rates are staying in a range of about 0.25%. For VA rates, I'm generally seeing an average of the low to mid 6s. Randy, what about for what you're quoting for veterans? Do you find that, is that about right, or are you able to do a little bit better, or do you find that I'm off a little bit? What are you finding for VA rates these days?
I mean, we're doing a little bit better than that, and then there's been a couple of days where that there's just been some sweet spots. As you know, because of the way that rates are built from mortgage-backed securities on up, there's sometimes at different lenders have some little sweet spots where that your rate at 6 and 5.625 are really pretty close together, whereas the rates at 5.75, 5.825 are higher, are costing more for that. We've been locking some stuff at like 5.625 with a small discount.
Really?
That's been pretty
awesome
for people.
So for everybody, just a quick recap, when you say a discount, generally that's either a discount point, a full point, or a percentage of a point. What is a discount point?
The full discount point is 1% of the loan amount that buys the rate down a certain amount.
Okay. And if somebody is looking to buy the rate down, right? So a clear example, you said instead of 6%, they may be able to get 5.625, and would they have to put a full 1 point down, or is that sometimes less than that?
No. What I'm talking about, I'm not a big believer in buying down the rate, a full discount point, etc. But if it's a small amount, you basically just have to do the math. And like, for instance, the one that I locked at 5.625 was a pretty large loan. Cost them $1,000 to buy it down to 5.625. It saved them $200 a month. So
Right.
so that $1,000, 5 months in or 5 payments in, they had broken even. And obviously, in the market that we're in, they were counting on refining in the future, but it still made sense. Whereas if you're in, buying down with a bunch of points, you have to see how much the math works out as far as how much money you're saving every month, divide that into how much you're spending on discount, and it's that many months before you're breaking even. So if it's $1,000 and you're saving $50, then it's going to be.
It's going to take you 20 months. It's going to take you a lot longer. Yeah,
exactly. So you just have to figure out the math on it and see if it makes sense. And I'm just generally not a big fan, particularly with the fact that smart guys like you and several other people that I subscribe to, believe in the next year or two that rates are going to come down from where we are now.
Yeah,
so it makes more sense, particularly with a VA loan where an IRRRL is a simple, painless, opportunity to get that lower deal than instead of spending, $4,000 or $5,000, $7,000 now to buy a rate that's only a little bit less. Hold on and look forward to an IRRRL a couple of years down the road or a year, however long that works out to be.
Right. And when you talk about an IRRRL, you're talking about an interest rate reduction refinance loan. That nice big mouthful of letters there. And when somebody is considering an IRRRL, a couple of caveats when they're looking to take advantage of that. You want to just tell everybody what exactly is an IRRRL, and then I've got it on the screen there. What are a couple things they should be aware of?
Yeah, the biggest thing is that it has to make sense. And previously, up until some legislation went in place and they put some rules in place, it didn't necessarily have to make sense. The borrowers can do it at will, but there were bad guys that took advantage of that. And so now you have to have at least 50 basis points or half a point in rate improvement for the most part, and you have to recoup the costs in 36 months. So that's the high point. There's some other instances where that you're going from maybe an ARM to a fixed or whatever that have to pass test too. But in general, most people are going to be looking at that test that we just spoke about.
Very good. Well, thank you. So let's go ahead. Let's keep chatting about rates a little bit more. So as far as, you said there were some opportunities where you've seen that somebody could get their rate down even below that, low 6 area with a little bit of a point concession there. Conventional rates I'm finding are generally in the mid to high 6s. They do tend to run higher than VA rates. So one of the benefits to getting a VA mortgage is you will find that oftentimes the interest rate is a little bit lower than conventional rates. But let's talk about where we think rates are going to go. And this is no surprise to probably anybody that watches on a regular basis that I think rates are going to continue in the range that they're in right now. Same thing that I said before. In fact, if I said what I say last week and what I say today is the same thing, that they're going to kind of stay the same. We don't have anything really going on over the next few days on the calendar to really get anything excited about. We've got some unemployment data that'll come out on Thursday. That's normal. Friday, I don't even think there's anything on the economic calendar. Next week, we've got some economic data, PMI report, which is basically just an economic report. If it shows signs that the economy is slowing down, we'll see a little bit of a reaction to help mortgage rates improve just a smidge. We've got the PCE inflation data comes out next Friday, and we've already seen, though, that there's two different inflation reports, y'all. There's the CPI inflation report, which stands for Consumer Price Index. And then the Fed's favorite gauge of inflation is the PCE, which is the personal consumption expenditures. And it's just a different way of coming up with what do they think the inflation number is. But we've seen inflation that's been going down steadily since June of 2022, which is good, but maybe not good enough, right? So that's kind of where things are at. One thing I would be watching for, I'm going to show this up on the screen, Randy, and we'll kind of explain to everybody. This is Fed futures. So right now, when you want to look and say, well, which direction are mortgage rates going to go, Helmer? I would point out to you that it depends on what the Fed is expected to do at their next meeting in June, and also what they're going to do in their meetings moving forward. So we have a meeting in the middle of June on June 14th where the Fed will meet, and then they will either raise the Fed funds rate, they will pause it, or of course they could start cutting it, but that's not even remotely in the cards right now. Expectations are that the Fed is going to pause, that they may stop hiking rates. And we've seen 10 rate hikes in the last 14 months at the 10 consecutive meetings. But there's a growing consensus right now. It's now up to 33% probability that the Fed may raise rates at this next June meeting. Now, about a week ago, this is a chart that compares where we're at now to where we were. This dark blue line is one day. The darkest line is today. As you go to the lighter color, it's the longer time behind us. So right here, a week ago, it was 99.6% expectation that the Fed would pause their rate hikes at this next meeting in June, that they would announce that they're done hiking for the moment. They want to let the dust settle, see what all these rate hikes have done to the economy and to inflation. But right now, the expectation is much higher that the Fed may actually put in yet another increase. Now, if the momentum behind the idea that the Fed is going to raise rates again at this meeting in a couple of weeks, actually a month from now. So if that momentum continues, we're going to see interest rates just creep a little bit higher. If we see that we get some economic data that shows the economy is slowing down and that sentiment moves back in the other direction and the markets say, okay, we were wrong, we think the Fed is going to go ahead and pause, then mortgage rates will go to the bottom end of that range we've seen, maybe get 1/8 of a point or even a 1/4 point better. So that's kind of something that we can watch to get an idea of which direction are things expected to trend. Randy, anything you would add to this or question about this?
No, not at all. Just we're kind of in an interesting situation as far as everything I read. That there's a lot of people still spending money, and that's a concern that kind of for me makes it where that it's not as black and white, because that there's folks using credit cards that more so than they were over the past couple of years, and some different things that come to play. And so it's not as black and white as I would hope it would be at this point in time.
Yep, there is. I will throw this up on the screen. Just a quick Google search. There's a lot of headlines hitting out there. U.S. credit card debt hits an all-time high of $930 billion. I've all seen other numbers of $968 billion. Whether it's $930 billion or $968 billion, what's $38 billion amongst friends? Definitely a lot of money. And this is what should catch everyone's attention, is that people are spending money that they don't have. And what that's doing is it's keeping the economy moving. That's why we haven't seen the economy slow down as much as the Fed has expected. But what happens is we're kind of just stretching out a rubber band that's going to snap back. So once this kind of catches up with everybody and we're no longer able to continue, that's one of the expectations of what's going to drive us into a heavy recession. And when we do end up in that heavy recession, what usually happens to mortgage rates in a recession, Randy?
They get better.
Yeah. Unfortunately, right? Yeah. Usually the happens is that mortgage rates tend to get better if we do get a recession. And that's why we talk about a while back, even though it had to be almost a year ago, we had a lot more expectation, a lot more talk. Hey, we're headed into a recession, we're seeing the signals, we've got all these different things. And we saw mortgage rates back this time last year. They kind of went into a nice little lull, like we talked about, because everybody was getting ready for that recession. But the recession, it didn't really happen. And, so things actually have gotten worse. Another big topic I know that's on the headlines, some of our viewers may be questioning. Have you read anything or talked about the debt ceiling and some of the drama there?
Yes, I've read enough about it just to know that we better pray that we don't that we don't run into that one, because they're talking about rates in the high 8s and 9s if that happens. So,
and I'm going to challenge that one. I would love to. You follow some of the other mortgage commentators out there, and they probably have some really great insight into this. But this is an article on Bloomberg, and they quote Zillow, and they say Zillow is the one that uses that 8% number that you used. And the idea is this, folks: if the United States defaults on its debt, it means it's not servicing the debt that we currently have. Then what happens is we become a higher credit risk, and our cost to borrow is going to go up. And as of right now, US debt is considered to be the most gold standard of debt. And the problem is that we're in a situation that sometimes you find in your own household. Maybe in order to pay the bills at the end of the month, you got to borrow more money to pay the money you already owe. And that's what the U.S. has operated that way since 1960. I mean, I think it was 1917 was the first time that that we started hitting a debt ceiling. In the 60s, they actually created a debt ceiling so that Congress didn't have to approve every time that we issued debt. So they said, okay, well, we're going to give you a limit, and we're going to let you go ahead and borrow up until that limit. Once you get to that limit, though, then you got to stop. And then what happens is, let me look at the number. I have it on my thing here. We have had 78 times that the debt ceiling has either been increased or suspended since 1960. So this is not something new. This has happened 78 times before. And at number 79, though, as often is the case with anything being done by our government these days, a lot of partisan politics, and no matter where you might stand on that spectrum, the bottom line is that it slows down the gears and things not necessarily getting done. So there's speculation that if we were to default, that we would, see rates jump. Zillow used a number of 8%. I cry foul on that one. What would happen? Here's what you have to look at is that if the U.S. were not paying their debt, what would happen is the value of our treasuries would go down in trading, which would drive our yields higher. And that's why mortgage rates would be expected to go up with that. But mortgage-backed securities are not U.S. debt. So I think we would actually see mortgage rates stay low, because I think we'd see a lot more investing money go from treasuries into mortgage bonds. And by doing that, it would actually help keep mortgage bonds low. Hopefully we never find out if I'm right, but that's my logic to this scenario. And I don't, and as long as mortgage bonds don't, and this is that fancy chart we show you guys all the time, if mortgage bonds don't go crazy, rates aren't going to go crazy. So I don't think mortgage rates would actually jump to 8%. I think that we would see them stay much closer to where they're at now. I don't think they drop, but I don't think they would go up all that much, because I think mortgage bonds would actually be a big beneficiary if treasuries were to all of a sudden become problematic. What do you think, Randy?
No, I think that's great news. And when as far as a 30,000 foot view, that I don't ever trust anything that Zillow says.
Yeah, exactly.
Anyway, I mean, that's just not in my ability to do. And then the fact is like on the forums where it was being discussed, it was pretty much discounted. But I'm still hoping we just don't go there. So.
I'm hoping so too. And in fact, a lot of people say, well, when do we have to have this done by? What's our drop dead date? And that's kind of the thing. Is it's just like if you were broke and you're waiting for your next paycheck. And back when I was a teenager, we literally would be looking in the couch cushions for money. You'd be checking the door panels on your car. You'd be looking on the floor mats. We just keep looking everywhere to find a little more money to keep the government running. So there's not a hard stop. There's a June 1st date that's being thrown around, but we've, it's actually the Treasury Department's job to find a way to pay these bills. And they, will rob Peter to pay Paul, and they'll borrow and they'll do things. So this date of June 1st is being used, but it's not actually a hard stop date. There is no hard stop date. So hopefully, though, there is some movement. There's some talk amongst the parties. Hopefully we get something done over the next week. But right now, believe it or not, as much as I see headlines, it's really not affecting mortgage rates. The debt ceiling is affecting other avenues of investing in the markets, but it's not really hitting mortgage rates. Anybody that says it is, I would challenge directly and say, show me how, show me where, because I don't think that we've really seen mortgage-backed securities, the bonds that mortgages are based on. I don't think we've really seen them shaken up by the debt ceiling issue. Even treasury yields haven't really moved all that much on it. So, for those of you that have asked about that, don't worry too much about it. until we actually default. That's when we'll find out exactly what kind of effect it's going to have. So, and like you said, Randy, hopefully we don't find out.
So speaking of defaults, one question I have for you is talk to me about these almost bank defaults that we've been dealing with over the last month.
Okay. What specifically do you want to know?
Like
what effect they had on mortgage rates, or what?
Yeah, exactly. So there's like 7 different banks that almost defaulted, that were taken over by someone else, etc.
Yeah.
What's going on with that?
So, just to give the background on what Randy is talking about, a lot of this is in what we call regional banking compared to what we call too big to fails. So the national banks, Wells Fargo, Bank of America, Chase, these are banks that are considered too big to fail based on 2008 standards, when we had a huge economic devastation. And, we had a lot of banks that were failing, Lehman Brothers and things like that, Washington Mutual. So anyway, we had what we call regional banks, and some of them were quite large, that did fail. And that term of failure meant that they had people that were looking to withdraw their money. And when they wanted to withdraw their money, that was going to cause the bank to actually lose way too much in their reserves, or they were going to be in a situation that they couldn't pay that money out. And that's why we have our FDIC insurance. What happened is that a lot of this, believe it or not, in the past, it was caused by poor decisions with lending for credit, giving money to people who couldn't pay it back. It was that's what led to our banking issues in the past. This time around, it's much more complex, because the banks are required to have a certain amount of assets in reserve. And the way a bank works, the way a bank makes money, is it takes money in and deposits. It takes a large portion of those funds and lends them back out, so that it can bring in money and make, let's say an average of 4%, and it pays out its depositors 2%. And then there's a 2% profit in the middle. And that's an oversimplification, but that's how, banking works. And what happens is that these banks they have to keep a certain amount of money in reserve, that when people want to take their money back out, that they can go ahead and pay that out. If they don't have enough in their reserve, if let's say I've got $1 million and I've got to pay back out 500,000, and I need to pull back some of that money that I've lent, or sell off some of my investments. And that's really where they hit into an issue, is that they were buying very safe treasury securities, mortgage bonds, that kind of a thing. They were buying them at a very low rate of return. Mortgage rates, interest rates have gone up because of the Fed. Now, if they sell them, they're worth less. So if they hold them to maturity, they're fine. So the idea is that as long as they had them, they were okay. But as soon as they have to sell them, now they're taking a loss. And those losses are what led these banks to fail. And it was because the reason they took the losses is because they had to cash out so they could have the money to pay their depositors. The reason they had to pay the depositors, and this is what's so different today, is because of mainstream media and social media. So somebody gets up and I say, Randy, if you've got money at LaCroix Bank over here, you need to take your money out. And maybe you own a company, Randy, and you're paying your payroll. So it's not just that you've got a couple 100,000 stashed away, but maybe you've got $2 or $3 million because you've got 150 people and you've got payroll, and you've got to have all this money in there. Well, Randy pulls his money out, and so do 10 other Randys. Well, now there's a run on the bank. And that's really what we had happen, was these little mini runs on the bank that started on a couple of key banks that caused them to fail. Then it brought a spotlight to the situation. And then other banks, as they were then saying, okay, this is bad, we want to protect ourselves, we're going to start setting ourselves up where we can borrow money in case we need to do that. Well, then what happened was someone, wait, they're borrowing money. They're in trouble too. And then it put up a red flag, even though they were just trying to be preventive. That actually made it look like they were in trouble. So it all spiraled. And of course, the mainstream media and all the headlines, and then it affected the stock market. So right now, everything's actually pretty stable. We've seen most of that run its course. There's still a little bit of movement in there, but that was why we did see rates drop about 6-8 weeks ago, or actually it was beginning of February. Man, time flies. We saw that happen at the beginning of February and all through into or was it? Yeah, it was February or March when it was.
March.
It was the March one. Thank you. So it was in March that we saw that happen, and and all of that. So anything, obviously, kind of what I was talking about there, and we're throwing that up so that our viewers could get an idea. Anything you want to add to what I rambled on about that?
No, it just reminds me of It's a Wonderful Life.
Mhm.
Yeah, where that's exactly how that scene went, where the people just got crazy and showed up and they wanted their money just because people told them they had to go get their money.
Yeah, and that's very much so. Well, Randy, again, thank you for joining me this week. I appreciate you, my friend. I'm sure I'll see you again. Anything that you want to say to everybody before we wrap up?
Nope, just thank you so much for doing this and sharing it, and you help a lot of people.
Thank you. All right, everybody, take care, everybody. Bye-bye.